Okay, welcome everyone. Hope you're having a good day. This is the first chapter here, the recorded lecture of the role of the public accountant in the economy. And so this is kind of a foundational chapter in the sense of we need to understand what it is that a public accountant or an auditor does. Why is it valuable? And before we really dig into the meat of how you do auditing, we need to make sure we understand the motivation. So if we look here, we have a set of learning objectives, and for every chapter I'm going to put these out and then attach priorities to each of the learning objectives, because I want to be able to guide you to the areas that I think are most important, the areas that I would encourage you to spend the most time understanding, and these are going to be the weights in which I will construct exams using these learning objectives. So, and I will spend time making sure that most of the points are coming from the high priorities, the next chunk is coming from the medium learning objective priorities, and then the low priorities have much lower weight given to them on the exams. Okay, so let's go through each of these. The first one is understanding the nature of assurance services. Right, assurance services are kind of the broad umbrella under which auditing falls, and so that's pretty important. And so we have, if you think about the breakout between services that a public accountant can do, we have the assurance services and the non-assurance services. And attestation services are kind of underneath that umbrella of assurance, and those are going to be financial statement audits, examinations of internal controls, and others. And essentially there's going to be some assertion around information that clients are making, and we're going to, as auditors, going to come in and provide some evidence around that assertion. We're going to attest to the assertion that the client is making. Okay, and we'll get into more. We'll talk a little bit more about attestation in a minute. Other assurance services would include things like a debt covenant letter, and so firms raise funds from lenders, for example, right, with debt, and some of those debts have covenants attached to them, in the sense of covenants are basically, okay, as a firm, for example, we pledge not to raise our debt to equity ratio above a certain percentage, right? Or we pledge not to make dividends unless our earnings is a certain amount over the interest payment, right? The yearly interest payment. So things like that become debt covenants. And so at the end of the year, the CPA, which the audit firm, will come in and basically evaluate those debt covenants and see, did the firm in fact keep those or not, right? So that's a type of assurance service. Similar for underwriting for some financial instrument, providing information around what's provided to the underwriter of a given financial instrument. Then the other big category is non-assurance services. So this is where tax comes in, and we can break tax out into compliance, right? Basically creating or helping the firm to complete their tax returns, and consulting. And consulting is basically beforehand, before we do anything as the firm, before the firm really engages in transactions, how can we help the firm, our client, to structure those transactions in a way that gets a good tax treatment at the end of the day, right? So compliance is more on the back end. After we've done everything, let's go ahead and report it. But consulting is on the front end. Before our client does any transactions, let's help them to structure it in a way that would be advantageous. Then the other big category is consulting services, and so there you have multiple, and there's other things that public accountants do, but those are kind of the big ones. I really like this figure. This is a nice general framework. I took it from the ISACA COBIT documentation. ISACA is an Information Systems and Control Association, so basically IT auditors. But I think it nicely encapsulates assurance engagements, and at the heart of it is a three party relationship, right? We have an assurance professional like an auditor, we have an accountable party like managers, and we have users, right, like shareholders. And so these the assurance professional is the one that does the actual assurance or audit engagement. And there's multiple parts of that, right? What's the scope of the engagement? What's the subject matter in which we're going to provide some assurance? For example, financial statements. What's the criteria against which the subject matter will be assessed? For example, GAAP. And obviously the auditor or assurance professional is going to actually execute the engagement, right? And then lastly, we have this conclusion piece, and that often will provide some kind of report. Sometimes they're internal reports that go to accountable parties and users. Other times they're public reports, right? Like a financial statement opinion from the auditors, okay? And so this, we'll talk about different kinds of assurance engagements throughout the semester, but this really captures kind of if you generalize all those assurance engagements, all of them have to fit into this framework. And so I think it's really helpful to understand that. The second learning objective is identifying assurance services that are specifically related to attestation. So financial audit falls under this. And so what do we mean by attest or attestation? So when you attest to something, it means you're providing assurance as to its reliability. And we're talking about information, right? So we'll talk about this in more detail as we go, but managers are going to put out an assertion or a set of assertions, let's say about financial statements, right? That they're complete, that they're accurate, those types of things. And so auditors are coming in and they're going to basically collect evidence to attest to their assertions around the financial statement information, right? And so that's going to provide some comfort to the users, okay? So we have different levels of attestation engagements. One, or the highest level, is an examination. So financial statement audits would fall under that. A review would be the next level. And then we have, lastly, agreed upon procedures. So the level of work it takes to achieve those. So for example, examination requires the most work. Agreed upon procedures requires the least amount of work, right? So instead of an examination where we have a lot of procedures we're having to do in order to give comfort around the subject matter, as we go down to review and then agreed upon procedures, the number of procedures goes down and down, okay? And so because of that, they provide different levels of assurance. As far as the criteria goes, which we referenced in that framework, standards are established, and I put experts here in quotes. It really, I put them in quotes because FASB, for example, it is a group of experts. It's not a group of the experts, right? They don't necessarily, it's not like they are necessarily the most knowledgeable around accounting in the world, right? So usually what this means is standards that are either imposed by some governmental entity, as this is from the group that we're giving weight to, right? Like the FASB, because the FASB has the support of the SEC, or the reputation of the standard setting body has grown to an extent such that everyone recognizes them, right? Like the ISO 9000 standards, right? There's no governmental authority that basically says you have to follow ISO 9000 standards. It's just something that's developed over time to be recognized as a best practice, okay? All right, learning objective 3 is also an important one, and there the focus is describing the nature of financial statement audits. And so, right, if we fit this financial statement audit into our assurance framework, the financial statements are the subject matter, right? GAAP is the suitable criteria, and auditors are going to gather evidence in order to provide a high level of assurance that those financial statements do in fact adhere to GAAP, right? the other appropriate basis would be referencing like IFRS, for example, if you're an international firm. And so we'll talk about the audit process as we go, but ultimately the crux is, can we collect enough evidence that we feel comfortable with forming an opinion on the financial statements, right? That's the goal at the end of the day. Okay, so it's important, even though, I mean, this is a super high level at this point, but this is ultimately what we're trying to do. Learning objective 4, explain why audits are demanded by society, and this one is a pretty important learning objective. Auditors lend credibility to information by reducing information risk, which is the risk that information is materially misstated. Oops, sorry, getting a little excited there with the animation. So it's the risk that information is materially misstated. So if you've taken finance before, there's different risks, right, that the markets are trying to identify. Well, information risk is basically the risk that the information the market is getting, or any user really, is not reliable. Okay. And so where do we get these misstatements from? A large number of them are just errors, right? We have people that are still doing this, even though we have a lot of technology that's involved. And so because we have people, we still have the possibility of errors. We could have a lack of knowledge around what the appropriate accounting principles or the accounting standards require us to do, either as preparers or as auditors. For example, consider some new transaction, right, where it's an emerging issue for how to deal with some complex transaction that no one's done before. Then that would be an area where we could easily have misstatements. We could have unintentional bias, right, where managers are just generally optimistic. They just generally think they're going to be able to fix things. They think that things will turn around. They think they have the ability to do it, so that's unintentional. And then obviously we have the possibility of deliberate bias or deliberate falsification, intentional misstatements due to fraud, and that's also a category, right? So this business risk point here, even though they're not directly dealing with that on a consistent basis, or excuse me, on a very explicit basis, when it gets to the place that business risk is very high, auditors actually do have to deal with it in the sense of now they have to wonder if there's really a going concern problem, right? Do the auditors think that the firms will not be able to continue in the near term? All right, so one of the helpful things that economics has done is help explain how we have situations where when there's information asymmetry in a market, how does that impact the market? Okay, so information asymmetry is a fancy word to say some people have more information than others. Okay, so imagine a transaction, you have buyers and sellers. So if the sellers have more information about what they're selling relative to the buyers, we call that information asymmetry. And so what this Market for Lemons paper did is he basically said, imagine there's a distribution, a normal distribution of the quality of used cars for sale. And the sellers know the quality, but the buyers don't, right? There's not a lot of information, so imagine this is before the days of Carfax and Edmunds and all the different things that we have, Kelley Blue Book. Imagine that scenario. And so we don't know the quality as a buyer, so what do? And so he had to make some assumptions, right? Buyers are rational, sellers are rational. And while that may not be perfectly true, in general, people have a reasonable amount of rationality. And so if that's the case, a buyer's going to, if he knows there's a distribution out there, knows the distribution, just doesn't know where a given car lands, what they'll do is they'll basically say, I'm willing to pay the average, right? I'm willing to pay the expected value, if you remember from your statistics class, which is in this case just the average of this distribution, right? We're kind of assuming that quality goes into price. And so if you are only willing to pay the average, which is in the middle of this graph, and the sellers look at that and they say, you know what, I know my car is worth more, the high sellers, and so they just decide they're not going to sell the car, right? And so they drop out of the market. Well, if that's the case, then the buyers reassess and they say, well, now let me look at what the existing quality of cars is, and let me offer the average of what's left over. And so then their willingness to pay goes down, right? And so because the average went down of the cars that are on the market. And so then the sellers that are higher than that also drop out, right? And so we get this unraveling of the market. And the bottom line of the paper was that when you have extreme information asymmetry, then ultimately the market will not be able to function, right? Because the buyers will price protect and the sellers will just decide that it's not worth selling the car, right? And so you get this unraveling, or you get to the place where everyone agrees that it's the very lowest quality, which that's where you get the phrase, the market for lemons, okay? And so a similar thing is true for financial statements and managers and users, right? So if you're trying to sell a stock and the shareholders don't have any idea where you land on the quality spectrum, then they're going to be unwilling to buy the stock, to the point that there's just no demand for the stock, right? And this is obviously an extreme. This is a kind of a corner solution, but the point is information asymmetry is really damaging. And so this is how auditors come in and provide value, is because they help the buyers to figure out where on the distribution the product, in this case the financial statements, would land. And so that's why there is a strong societal demand for auditors. Well before we had any mandates or anything from the government, there's this demand for auditors.